Good afternoon, everyone, and thank you for tuning in today. I am Eric Geedy. I am the Managing Director of CFA Society San Francisco. It's my pleasure to welcome you to our event today, What Taxes? Principles of Tax-Efficient Investing. We've actually had a change in our speaker lineup this morning or this afternoon, and we have Dominic Bellotti, Vice President and Regional Consultant at State Street Global Advisors, who is stepping in for Tony as our moderator. And want to remind everyone before we start that you will be muted during the entire event. But if you do have a question, we encourage you to use the Q&A box at the bottom of your screen, and we'll monitor those questions throughout the webinar and do our best to answer as many of those as possible. So now at this time, I'd love to turn it over to you, Dominic, and have a great event, everyone.
Appreciate it, Eric. As Eric mentioned, I'll be stepping in for Tony today. So appreciate the opportunity to bring this topic to you all. I think it's pretty pertinent that we're having this conversation this time of the year. Taxes obviously can be top of mind throughout the year, but at the end of the year, especially because of the tax efficient principles that we want to instill at the end of the year going into the following tax year, in order to perhaps mitigate some capital gains that we might be seeing here at the end of the year. So we have two fantastic speakers and panelists today. We have Brandon, who is from Morgan Stanley. He's an institutional portfolio manager covering municipal bonds. And then we also have the head of SPDR ETF Research. That would be Matt Bartolini as well. So let's go ahead and start off. Actually, I know I gave just a brief overview of the two of you, but Brandon, let's start with you. Can you give a quick overview of your role at your company, main duties, and then what are some of the most frequent tax-related discussions that you have? And then Matt, you can follow suit thereafter.
Yeah, thanks, Dominique, and thanks everyone for joining us today. Appreciate the time and the invite to talk about what we're thinking of with regards to tax efficiency here at the end of the year. Just as Dominique mentioned, I'm a managing director and institutional portfolio manager covering our entire municipal franchise. So what that means is all things within parametric tabs, that's tax advantage bond strategies, our legacy Eaton Vance mutual funds, and our Morgan Stanley funds as well. So all things municipals. I spend my days, I should say, meeting with advisors, meeting with end clients, discussing specific portfolios, positioning across portfolios and funds, talking about the muni markets on a day in and day out basis. Basically, relaying our views, thoughts, and opinions with how we're thinking about the markets. And with regards to taxes, given that it's a tax-exempt asset class with municipals, tax-related topics are generally a part of every conversation, right? Whether that's for, upper echelon tax bracket payers here in California, where I'm at as well, in SoCal, clients in other high tax states, whether it be Minnesota, New York, New Jersey, Oregon, etc. Quite frankly, the tax topic is a big piece of every conversation.
And Matt, why don't you jump in as well? So Matt's actually my colleague at State Street SPDR ETF. So really glad to have him on, and I get to see firsthand some of his research in the tax efficient space. So same question to you, Matt, around some of the things that you see on your end, and then also expand on your role at State Street as well.
Yeah, so I can start there with my role. So I'm the head of ETF Research, State Street Global Advisors within our SPDR ETF franchise. I lead a team of research strategists and research analysts that help sort of make sense of a very complex world by using very data-driven insights to inform investment-related conversations, portfolio construction best practices, and just general market commentary. Again, to sort of make sense of a very complex world, and also ETF education. And that's really where a lot of the tax-related conversations do come in, is around ETFs, the ETF Education 101, how the create redeem mechanism works and how it can create a more tax efficient strategy for the end user, but then also, how you can maybe use the confluence of overall ETF strategies out there to perform tax loss harvesting at year end when broad markets may be down or different economic sectors, because there's a lot of different ETFs out there, not all from State Street, but also that can, provide similar exposure and, be able to be a benefit come tax time for the whole portfolio. We've also written some other research around sector ETFs and the associated potential strategy around tax loss harvesting using sectors. And that's just something we continue to talk about as well. But mainly it focuses on that ETF education aspect, which there's a lot of threads to that conversation, particularly the rise of active ETFs and how that actually manifests itself also in efficiencies.
Thanks, Matt. Let's start to get into a little more detail here. And Brandon, I'll come back to you. Can you describe the SMA or fixed income ladder strategies that you oversee and what makes them inherently tax efficient? The investment process, some of the underlying assets, maybe it's a combination of both, but curious, as we look under the hood, what really makes some of those assets and what you're managing tax efficient?
Yeah, I'd say we run about 55 billion in muni SMAs, another 16 or so billion in muni mutual funds. The ladders, as you alluded to, is one part of that separately managed account business. Those are very customizable solutions. So whether it's somebody who is looking for a 1 to 5 year ladder or a 10 to 20 year ladder or something in between, like a 5 to 15, customizing around the state that they live in. So whether it's California, Arizona, Texas, etc. Obviously, for the national states, those with no state income tax tend to go the national route, right? Given all munis are tax exempt for them, regardless of if they're in state or not. And so really just a matter around, being able to customize these solutions. Again, we're talking about all tax exempt munis. We do run taxable SMAs, but that's a different buyer base than what we're discussing today. And ladders, I would say, is just one part of the overall platform. There's also an active managed muni strategy, which I think we'll get into a little bit in the future of this conversation. There's total return. There's some differences between the two, but really, we're looking to build a customized solution for each individual client based on their state of residency, based on what they want from an overall credit risk profile. Some clients like the idea of having triple B munis, some want AA and above only. And then also across, different maturity ranges as it relates to the ladders or duration risk as it relates to the more active strategies. And, just to your point around what makes them tax efficient, it goes back to the fact that, look, we're looking to, again, own all tax exempt munis. Matt brought up tax loss harvesting. I know that's going to be a huge part of today's conversation, but tax loss harvesting is something that we do on a systematic basis throughout the year. I know we'll chat about that further as well, but that's a big piece that helps, offset gains in the portfolios, and then obviously gives clients a coupon to offset taxes against the government in the future, if you will. So I'll just pause there, hand it back to you.
Yeah, no, appreciate the context. And I know as we go through this conversation too, whether you're an allocator, whether you're just an individual investor trying to learn, obviously we're coming at it from a couple of different angles here with Matt and with Brandon, and in terms of accessibility as well. But I think at the end of the day, whether you're from an institutional standpoint or a retail standpoint, you're going to be able to gain something here in terms of finding better strategies to create tax efficiency in your portfolio. So Matt, let's go to you. What are the differentiating traits of ETFs versus other pooled investment products, and what makes them exclusively tax efficient?
Yeah, so I think the easiest comparison is ETFs versus mutual funds. ETFs, they hold a collection of stocks and bonds just like mutual funds do. The largest difference is that ETFs can be traded on the secondary exchange. So you can go, to a market maker, trade between willing buyers and sellers at a fair market price, and transact on exchange, the secondary market. Mutual funds, you can only interact with the actual underlying fund itself in the primary market. Now, you can also interact with the fund of an ETF in the primary market as well by leveraging the creation redemption mechanism and creating shares of the ETF. Now, the tax efficiency is gained through that creation redemption mechanism. So if, for instance, I have 100,000 or say $100 million, I want to buy one of our ETFs, I can place that order, in the exchange on the secondary market through a trader, and that could outstrip the amount of demand of shares for that ETF. Maybe a market maker is only quoting 50 million shares. So there's a 50 million difference between the demand I have and the supply that they have. So they can go to the ETF issuer like State Street and say, we would like to create 50 million shares of XYZ ETF. State Street will say, well, if you need to do that, you need to give us the underlying basket of stocks, and perhaps it's the S&P 500. So the trader, AP, market maker, all sort of similar nomenclature for those firms. They tend to be some of the same people. They'll go out and they'll buy all the S&P 500 stocks, or they maybe have it in inventory already, and they will transfer those in kind to the ETF, to the issuer, and in return, we'll send them back the shares. That is an in-kind transaction. And when we do it on the reverse side, when there's a redemption, like if I wanted to sell my 100 million and the market maker didn't want to hold on to that 100 million of shares of ETFs, they would go to the ETF issuer and say, hey, I want to redeem these 100 shares. In doing so, the ETF issuer, ourselves, would basically send the 500 stocks back and say, here you go, here's the 500 stocks in lieu of the shares. You go do what you will with them, but our transaction is done. That is an in-kind redemption. It's non-taxable. So the tax efficiency is gained because when supply and demand are not balanced in the secondary market, the primary market is where the funds will go, and is in a tax-exempt manner, in a tax-efficient manner, because those in-kind transactions are not taxed. That's where the first tax efficiency comes from. The second one is not all the transactions between willing buyers and sellers do need to hit the fund. On a mutual fund, that's where it happens. If I buy and you sell, Dominic, the mutual fund, that goes right down in the mutual fund, and they have to aggregate those positions. In ETF, maybe our transactions cross on exchange. And that's what we call dual avenues of liquidity. So it's additive liquidity in the secondary marketplace. And typically what we see is for every $5 traded on the secondary market, only $1 goes down to the primary market. So it's basically a 5-to-1 secondary to primary market liquidity ratio, and that creates tax efficiency. So long story short is, versus mutual funds, ETFs have two legs of liquidity to stand on that allows for improved tax efficiency, while mutual funds only have once. And when a mutual fund transaction is incurred, where if I want to sell my mutual fund shares, the portfolio manager has to raise assets in the cash market. For an ETF, there's no raising of assets in the cash market. Those assets, the stocks, are just delivered out in kind to the authorized participant in lieu of the shares that they want to redeem. And that's the basics of ETF 101, as easily as I can explain on a webinar this late in the day. But it's very operationally nuanced, and there's a lot of operational alpha associated with it.
And as a quick follow-up question too, Matt, and I know you've put some research out on this in the past because I've had a chance to read it. What percentage on average over an extended period of time or what percentage of mutual funds typically pay a capital gain versus ETFs? Just curious.
So, obviously going to change by year. Last year was not a very good year. More than 50% of mutual funds pay capital gains. I actually want to say in some asset classes, say U.S. large cap equities, it was almost 80% of mutual funds pay capital gains, particularly active ones. On the ETF side last year, only, I think, 4.5 or 5% of ETFs paid capital gain distributions last year. Our firm, as you know, Dominic, we paid zero. None of our ETFs paid capital gains this year, and I think only one of them paid one last year. And the prior year, only one did as well. So inherently, there's a persistent bias for mutual funds to be less tax efficient than ETFs because of the differences in operations and operating models that the ETFs have, particularly that creation redemption mechanism.
Awesome. Appreciate the context there. Brandon, let's come back to you here and focus on trends a little bit. Having increased flows to SMAs and muni ladders made it harder to generate returns when you have a lot of money kind of flowing into the same part of the market. And SMA managers, they have a reputation among some traders as price insensitive buyers on the front end of the curve. So again, curious, like, has it been harder to generate returns as money has flowed into those types of strategies?
It was certainly harder to generate in 2021 when yields were abysmal and outrageously low, and there was a tremendous amount of money going into muni in general, right? 2021 was like the best year ever on record for muni mutual fund inflows. It was very good for SMAs. And then last year, you actually had the worst year ever on record for muni mutual fund outflows. Interestingly enough, though, to your point, I would say the trend has very much shifted, if you will, where there's a lot of flow that's going into the separately managed account side of the market, whether that be because of the customization features that we talked about. It's a very retail dominated asset class, right? That's all of us on this call and all of our clients, and they want to own the individual bonds. They like to know the names, or they want to see, that the bonds roll off and mature at 100 cents on the dollar, or a whole host of other reasons for why, people want to own individual bonds. But I'd say definitely would agree that, this year has been very strong for SMA flows. But on the other hand, muni mutual funds across the industry have actually seen about negative 24 billion of outflows. Thankfully, we've seen inflows to mutual funds, but probably to Matt's point, muni ETFs have seen pretty strong inflows. So not sure if it's a long-term trend change, but nevertheless, definitely has had some shifting in the landscape over the last couple of years. I'd say for us, with regards to, price insensitive buyers, to your comment, obviously we're looking to be as price sensitive as possible. A lot of the transactions that we're doing are in the new issue market. So, looking to transact upwards of 70% of the buying in the primary space. We average about 300 million in dollars traded on a daily basis in the muni market. And so, that puts us as one of, if not the most active muni SMA manager out there. And so we, with coverage from 100 plus broker dealers, we like to think that, we have better access to not only the primary space, but we're one of the first on the call list when there's, bid wanteds or inventory moving elsewhere. And so I think, look, in periods where there's a tremendous amount of money going to one particular part of the curve, yeah, you got to be a bit more tactical and strategic, right? You can't just be blind to prices and just blanket buys. But I would say, again, given our platform, given our technology resources, kind of pride ourselves on having technology that stands apart from a lot of our competitors. I think it allows us to be a lot more thoughtful in portfolio construction and how we go about building these SMAs.
Absolutely. Let's change gears a little bit here, and Matt, I'll bring it back to you. A lot has been made of active ETFs over the last few years, right? I mean, they've been out for a decent amount of time now. I know we were one of the first to launch active ETFs several years ago, in conjunction with some sub-advisors, but there have been more and more active managers moving into the active ETF space, whether it's through conversions or whether it's through standalone products. How do these vehicles complicate the tax profile of an ETF? Are they more tax efficient? Is that something that investors should be using over the mutual funds still in the first place? And then how do they stack up maybe versus some of their more passive counterparts?
Yeah, so just first and foremost, active ETFs have been massively in favor this year. So active ETFs they surpassed records already for total annual flows, and we still have basically 2 more weeks to go, but they broke it actually at the end of November. So $112 billion of inflows into active ETFs this year. I think we're going to probably end up around 122, give or take. That obviously is a record. We've seen a record amount of launches, new categories developed. There's also a significant amount of funds that now have an identifiable track record of over 5 years. Like I said, like a handful of them are ours. We We definitely have some launches from the 2013, 2015 timeframe, and we're not alone. There's a lot of managers that have those identifiable track records. More comfort has been given to the notion of active ETFs that are transparent in nature. So it has become more of a mature market, but it's growing at a pretty entrepreneurial rate too. The tax question though, active ETFs are less tax efficient than passive ETFs historically. So like I said, 6% of passive ETFs paid cap gains last year. On an active construct, you're looking at around, I think it's like 15 to 16% of active ETFs paid capital gain distributions last year. Conversely, mutual funds are in the 50s, right? And if we look at just even break it down into fixed income mutual funds, I think it was something to the degree active fixed income mutual funds paid like 32% of them paid cap gains last year. Active fixed income ETFs last year was around 19% of all active fixed income ETFs. So relatively, if we're looking at sort of a tax efficiency curve, passive is probably the most tax efficient, then active ETFs, and then you get to the mutual funds, passive mutual funds, then active mutual funds. And part of it is strategy, rebalancing, et cetera, but then also the operational aspects of it. So with some active ETFs, though, they don't use the creation redemption mechanism, right? They're maybe a concentrated stock portfolio of 70 stocks, and they rebalance, once a year. And you're not rebalancing a lot, but you're gonna, what have you. You're not going to be able to leverage the same thing that we do in our S&P 500 fund. They rebalance quarterly. Or, and this is actually in some of the cases, particularly on the fixed income side, you're not in-kind creation redemption. You're what we refer to as cash create, cash redeem. So you're basically, when someone wants to come into your fund, that AP or market maker I described earlier, they are giving you $50 million in cash. And the portfolio manager can then go and do what they see fit with it. They can buy some undervalued loans or what have you. Similarly, on the redeem side, they're going to have to sell securities in the cash market, raise those assets, and then send the cash over to the AP market maker. Similar like what a mutual fund would do, right? Where I said earlier, on a mutual fund, they're going to have to raise assets, raise cash to fund redemptions. So all else equal, from that one comment, the active ETF construct and active mutual funds have a very similar relationship. However, as I said earlier, not every single client transaction goes through the primary market. So on average, you're looking at a 5-to-1 ratio, right? So for every $5 that's traded on the secondary market in an active ETF, only $1 hits the primary. That layer of liquidity is additive, not only from a liquidity perspective for trading volumes, but for tax efficiency. Because, and this has happened, we have real world examples of this. We actually, in one of our senior loan ETFs, which is a pretty illiquid asset class, right? We had a client want to redeem $100 million. Same time, there's a client that wanted to buy $120 million. They were able to meet on exchange and transfer risk in real time, and the underlying fund didn't have to do anything. There was enough willing buyers and sellers at a fair market price to transact. That second layer of liquidity creates improved tax efficiency relative to the same exact strategy run in a mutual fund because they don't have that second layer of liquidity. So all else equal, the most tax efficient style of an ETF would most likely be indexed because you can utilize the create redeem mechanism. But then, active ETFs are not too far behind it, but they are pretty far ahead of the active mutual fund constructs. And we have a lot of data to support that too.
Appreciate it, Matt. Brandon, let's go back to you and let's talk a little bit about tax loss harvesting, especially within your portfolio. So first of all, how do you pursue tax loss harvesting? Number one, curious what your process is. Obviously, don't give away too much of the secret sauce. We understand that, but talk a little bit about like how you think about tax loss harvesting. Is there a magnitude of loss that you need to be looking for in order for you to sell something? Obviously, in your space, you're dealing with individual QSIPs. It's a little more esoteric than maybe at the high level of some of these ETFs. So you may not be able to find something as like in kind within the portfolio. So curious how you're making those allocation decisions, those harvesting decisions. How are you making the decision to go into something else to keep the same construct or behavior of the portfolio too. And then what are you doing with those losses too, right? We talk about tax assets, if you will, over an extended period of time. Are you matching that with gains? Are you passing that off to the client? So curious about all those.
Yeah, all good stuff in there. Thanks for that. I would say first and foremost, the way we think about tax loss harvesting across our platform is from what we call a systematic basis, right? So systematic to us means, one, we do it throughout the year. We're not just waiting until, clients, maybe tax advisors come and say, hey, you can utilize some tax loss harvesting, which usually takes place in the fourth quarter. We're looking literally all year long for the best opportunities to take advantage of tax loss harvesting. I would say it's interesting. If you look at the muni market over the last 22, 23 years, muni yields have actually only ever topped out in December 2 different times. So the rest of the year has very much provided much better opportunity for tax loss harvesting. Around those points is, you're absolutely right. There is a threshold we want in place. Not going to be a lot of value add if we go out and tax loss harvest something at a quarter point, and then you got to factor in transaction or slippage costs, et cetera. So, we really want to have a 3, maybe 4 point loss threshold in very volatile markets, or maybe even very challenging markets like we saw throughout much of 2022. Maybe that threshold actually increases a little bit higher. But at the end of the day, want to make sure that it makes sense to your point, having adequate tax alpha. And I'll touch on that in a second. But when we have these cells lined up, the other part of systematic is the buys are lined up right behind it, right? So we want to have a replacement readily available with similar characteristics. If we're selling a 4% coupon, we want to replace it with a 4% coupon, or a 2043 maturity. We're looking for a 2043 maturity, so forth and so on. The other thing where the buys are lined up right behind the sells is it helps eliminate any sort of cash drag, right? And cash drag has been a huge part of every conversation this year, as you can imagine, because investors are finally paid to own cash, as they have been for over a year. So without keeping the clients out of the market, ensuring they've got ongoing market exposure, it helps reduce cash drag, keep the portfolio looking similarly, and then making sure that we have those tax alpha basis points across the platform. I'd say on a year-to-date basis, I'll just give you some numbers, or maybe front run a question you might ask me. Within our SMA franchise on a year-to-date, we've harvested about $500 million in losses, and that's been across north of 255,000 trades. It's saved over $145 million in tax dollars for our clients. And the way to put that into another number is the net tax alpha across all of our different separately managed accounts has averaged about 46 basis points, right? So covers our minimal fee multiple times over. But I think, just alluding to some of your points there up front, is systematic, done throughout the year, really look to avoid having any sort of cash drag. And then finally, just with regards to gains, there is an actively managed SMA that we run where we're constantly looking to exploit the pricing inefficiencies in our market. And what that means is basically looking to post bonds onto retail platforms. And if and when people come in and overpay, our clients benefit from that. There's no profit sharing. We find something else to invest in. So you got some gain realization there, and then try to offset it as much, if not more, with tax loss harvesting. One other thing you mentioned that I'll just, make a quick comment on is, you're right. We operate in a very nuanced market. There's a million different CUSIPs, 60,000 different issuers, a bit easier, if you will, to get around the wash sale rule per se, as opposed to the equity world, just given the fact of the sheer volume number of different CUSIPs that exist in our market. So I know there's a lot in there, but you hit on a lot of good points, things that we think about across our platform on a continuous basis.
No, that's really great context, Brandon, because obviously the world of tax loss harvesting, it gets extremely complicated from your level versus what we might see from an ETF level, for example, when we're just talking about like in kind tickers. But let's zoom out for just a moment here. So Matt, we had a couple of questions come in beforehand from the audience, and I just want to pose a two-parter to you. What are some of the worst asset classes for taxable investors, number one? And then also a little more complicated or nuanced, what tax trends are you seeing within model portfolios as well?
Yeah. So I'd say there's probably two that come to mind from an asset class. And I like this asset class, but the question was if I liked it or not. The taxable high yield bonds tend to not be the most tax efficient on a long-term basis. So if you run any historical analysis, 100% of the return is derived from the coupon over like a rolling 10-year basis. So you're going to be taxed mainly at ordinary income rates. Not the most tax efficient, right? And it's sort of a low volatility equity play, but there's a lot of other benefits to it. And sometimes you're trading high yield more tactically based on a current market environment. So that's more of like an academic approach to it. Say like, on a 40-year basis, your after-tax return on high yield is going to be less because of XYZ ordinary income returns. And so if the majority of returns are coming from something that is being taxed at a higher rate than long-term capital gains, all else equal, you're going to have a sort of subpar after-tax experience. The other asset class, which has become very popular recently, are those derivative income funds. Derivative income funds sell covered calls, which is a source of income. And then really what that drives is high total return from income only. So if you look at the category, they, even over the last 2 years, the broader category is down on a price basis. So that's actually a tax loss harvesting candidate because your price losses are negative and you harvest those. But all of your total return is coming from income streams that are at ordinary income rates, which are higher than say owning the S&P 500 and selling 5% every 1 year and 1 day, where those gains are then be taxed at, long-term capital gains rates, which is like 20%. So the question there is, understanding the drivers of return, and in some cases when it's tax inefficient income, that can be detrimental. Now, high yield this year, right? To use that example. High yield is up on a price return basis and is up on a total return basis. So both price action and coupon, the carry, has benefited from it. So again, a lot of this is sort of in a vacuum, but if I had to answer the question, that would be probably the best way to answer it. The second part of your question around tax loss harvesting around model portfolios that own underlying ETFs within a traditional tactical or strategic asset allocation framework has been a major source of inflows for the broader ETF industry. Overall, ETFs are likely to surpass $500 billion of inflows for the fourth consecutive year. As of today, I haven't seen the nightly flows, but we're at 489 billion. Probably going to break 500 billion, I would think. And a driver of that, there's been two mutually exclusive groups that have been driving that. One is low-cost ETFs that makes up around 60% of it. The other is active that makes up 25%. So about 85% of flows this year have gone from two mutually exclusive groups. The drivers of those flows, the clients behind them, on the low-cost side, is the majority of model portfolios that are using ETFs to create these tactical or strategic asset allocation frameworks. So the question is, well, how do you perform tax loss harvesting? It's really where customization comes in the ability for the overlay manager to have an open architecture framework, then make that relative value decision between, say, harvesting your S&P 500 exposure and then going into the Russell 1000. There's still a lot of untapped potential there because there's not a lot of customization in the model ETF world. Also, there's a lot of, I would say, ambiguity around the wash sale rule. So Brandon mentioned that it's not a big of a concern in the muni bond space because there's 18,000, 30,000 different individual CUSIPs. There's a lot of gray area if you trade one S&P 500 ETF for another S&P 500 ETF, even though they're from two different firms with two different organizational structures, two different expense ratios, two different share prices. IRS has not weighed in on that. I don't expect them to do that either. We won't weigh in on it because we're not tax experts. So it leaves a lot of a gray area. But I think in what we spend a lot of time on in the model portfolio space is trying to figure out the right amount of customization to then have the ability to do tax loss harvesting when events do arise. And a lot of it comes down to technology too.
No, absolutely. So this I found as an interesting question when we were getting geared up for this webinar. We talk about tax loss harvesting, right? And we talk about tax alpha, being able to carry forward these tax assets and mitigate the gains that we may have this year or in future years, right? If we hold them for an extended period of time. But do we have enough data? And I'll start with you, Brandon. Do we have enough data to say that tax loss harvesting actually leads to better investment outcomes? Or does it just delay the inevitable that those taxes are going to be paid anyways? Like, are we over the lifetime of your clients, are they actually going to display better after-tax returns on a net basis?
Yeah, that's a really good question. I'd say if you look at kind of our separately managed account platform over time, we found that the average tax alpha is about 30 basis points. There's going to be years where it's a lot less, like 2021, call it low teens, 2022. The best year for tax loss harvesting, I say that jokingly because it was a brutal year for bonds, right? It was closer to about 85 basis points in tax alpha. So over time, in our opinion, the answer is yes, right? And I think you see that with regards to, again, 30 basis points-ish of tax alpha on a yearly basis. You can talk about the benefits, to your point, of having, those losses to offset gains in the equity portfolio or gains in your EM allocation or whatever the case may be. Or last year where there were no gains, then you carry the losses forward because they don't expire. And so also with the idea of resetting book yields higher, right? A lot of portfolios were built out in, call it 2021, when the market was flooded with demand, and then immediately the market sold off. Lots of opportunities last year and this year to reset book yields higher, and again, have that sort of coupon against future government taxes. So I think it's a really good question. Oftentimes tax loss harvesting in some of these ladders doesn't come into play because some clients, they don't want to realize losses in their muni portfolio, and they just want to know that bonds roll off and mature 100 cents on the dollar and get reinvested into the longer end of that laddered range, for example. So it's a moot point. But for those that are involved in the systematic tax loss harvesting or are more actively managed SMAs, over time, I think the answer is yes in terms of the value add.
It's a good point. And on the tax front of what we're thinking in the future, we're going to come back to that in just a moment here. So, and to get your opinion on that, because that is a very good point. And one of the other components or leg of the stool, if you will, on carrying some of those losses forward if you're going to have a higher, if you're going to be paying more taxes down the road. Matt, I'll pass to you. Same exact question too. Does it lead to better investment outcomes from what you've seen on your end? And I'll also prime that by saying, and I forgot to mention this before asking you the question, Brandon, but when you make that tax loss harvesting change, you are resetting your cost basis lower, right? So eventually when you do sell that asset, you are going to sell it at a larger gain if it continues to go up from there. So curious, like how is that being taken into consideration? And ultimately are investors being saved from an after-tax basis? And are they having better investment outcomes?
Yeah, I mean, I think tax loss harvesting, it's always a consistent topic, not only this time of year, but throughout the year. You have to do it opportunistically. And I think that's the big portion of it, because at any time you can improve your after-tax return by harvesting losses in one part of your portfolio and letting gains run. Ultimately, if you do this opportunistically throughout the year, there are markets that are going to be down, and you can then harvest those losses. So, one area that we looked at, and this sort of leads to a comment I made earlier around sector rotation, tax loss harvesting, is that on average over a given year, over the last 40 years, there's at least 3 sectors, GIC sectors, that are down in a given rolling 1-year basis. Even more so when the market's down, right? If the market's down, you're likely to have almost all sectors down. But on average, you usually have about 3. So you can harvest losses in some of those sectors. So the research that we did is you basically own all the sectors at their market cap weights. So there's 11 of them. If some of them are down, you sell and you rotate into a very different, another ETF that provides a similar economic exposure, and then hold that until it falls beyond a loss position, right? And that's one way to maintain market beta, but then tax loss harvest alongside it. And I think that results in an improved after-tax return relative to something that is just, buy and hold, and not being able to harvest losses. So I think it's been a positive for client outcomes.
And then, and it's funny you bring that up too, Matt, because I've seen, at least on my end in the field, other SMAs. This is kind of bridging the gap between, Brandon's field and Matt's field. We've seen SMA managers using our own ETFs within their SMAs to your point, from a sector basis, to do that tax loss harvesting too. So just another way to combine the two.
Yeah, I mean, one of the bigger reasons why, our State Street's fund flows get a boost in the fourth quarter because of motivated tax loss harvesting selling underlying stocks that are at a loss, and then parking that money in a S&P 500 ETF for about 30 days over year end, and then going back. And that is a very traditional approach or tactic that we see year in and year out. But one thing that we always talk to the end advisors and wealth managers about is that you do need to do tax loss harvesting opportunistically throughout the year. I think the joke that I always make is, if you're driving on a highway and you see a gas station, you should probably pull over to see if you get to use it. And because you might not know it, you might find another gas station on the highway for the next 200 miles, right? And that's kind of the same thing. We saw that during the regional banking crisis in March. Stocks fell pretty broadly. There's an opportunity to tax loss harvest. You should have taken it. And there's ways to do it, and there's ways to do it efficiently. But the biggest thing is also make sure it's not cost prohibitive. The transaction costs can accumulate.
Absolutely. Last question I'll leave you both with. This is probably the kicker of the lot, and I don't think we have any other questions coming in from the crowd either. So this should be the last one of the day, unless someone pops in here at the end. But Brandon, I'll start with you, and I'll ask you both this question. Do you expect tax rates in the United States to be higher or lower 10 years from now?
So the short answer is, unfortunately, yes, they will be higher. The longer answer is, unfortunately, yes, but for myself, you, Matt, and everyone else on the call who owns munis, it makes the tax exemption nature of the asset class even more attractive.
Well, I live in Massachusetts, what they call Taxachusetts. So sometimes we don't have to worry about the federal taxes, just the state and local. I think Brandon's answer, I think, is spot on. All else equal, probably a little bit higher. But all else equal, that makes tax advantaged, tax efficient assets much more attractive to use. And that could be at the single asset class level, municipal bonds, or at the sort of wrapper level within ETFs, because nobody likes to pay capital gains taxes. And again, like on the mutual fund side, like you're not the reason why you're paying capital gains. It's because someone else within the fund sold, and the PM had to raise money and incurred capital gains by entering the cash market. In the ETF, you control your taxes a lot more. If you sell, that's when you incur the capital gain or loss, right? All else equal, right? 6% of ETFs did pay capital gains last year. There's over 3,000 ETFs.
Well, if both of your crystal balls are correct, I think it's apt that we're having the conversation now. So hopefully folks heed some of the information that's been brought forth today to shift some assets to, whether it's ETFs, SMAs, municipal bonds, all tax efficient vehicles in the anticipation of, and tax loss harvesting in the anticipation of possibly higher tax rates in the future too. But that's all we have for today. Appreciate all the questions that came in towards the beginning of the webinar. Matt, Brandon, appreciate both of your participation too. I think again, it's a very timely topic here at the end of the year as people are making some of these decisions to try to capture some of that tax alpha going into next year as well. So with all that being said, Eric, I'll pass it back to you to close this out.
Thank you, Dominic. Again, thank you everyone for joining us this afternoon. It was a really great topic, timely, and I appreciate both Brandon and Matthew for your input and guidance on tax matters. And we appreciate everyone joining us today, and everyone have a great holiday, and we'll see you all in the new year. Thank you.
Thank you. Thanks, everyone.
Thank you.